welcome once again to Intelligent Investment Today. This is the podcast where we explore the principles that sit at the very heart of disciplined long-term investing. The ideas that help investors make sense of markets, not just when conditions are favourable, but also when uncertainty, volatility, and shifting sentiment test our resolve. And today we turn our attention not to a company, but to a person. A figure whose name has become almost inseparable from the very concept of value investing. A man whose approach has shaped generations of investors, and whose philosophy continues to offer clarity in a world that often feels anything but clear. Today we're going to examine the early life of Warren Buffett, the formative years that shaped his thinking, the experiences that influenced his philosophy, and the first major decisions that set him on the path to becoming one of the most successful investors in history. We will explore how a young boy from Omaha developed an obsession with numbers, how a chance encounter with a mentor changed the path of his career, and how his earliest investments, both the successes and the mistakes, helped forge the principles that underpin his approach to this very day. Because even the greatest investors are not born fully formed. They are shaped by lessons, by habits, and by the discipline to learn from every decision. So, as always, sit back, tune in, and prepare to take on board another lesson in value investing as inspired by Benjamin Graham. Warren Buffett was born in 1930 in Omaha, Nebraska, at the very start of the Great Depression. His father, Howard Buffett, worked as a stockbroker before later entering politics. His mother, Layla, was known for her sharp mind and frugal nature. But even in that environment, Warren stood out early. He wasn't the loudest child, nor the most athletic. But he had something else, a fascination with numbers, and an instinctive understanding of money. There is a well-known story that when Warren was 6 years old, he discovered he could buy 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents and sell each bottle for a nickel. A small profit, but a meaningful one for a child. Most children see a drink. Warren saw a margin. And that mindset would stay with him for life. By the age of 7, he was reading books such as 1,000 Ways to Make $1,000. By 10, he was studying stock tables in the newspaper, the way other children read comic strips. And by 11, he made his first investment. In 1942, Warren purchased 3 shares of Cities Service Preferred at $38 each. Almost immediately, the stock fell to 27. For an 11-year-old, this could easily have been a moment of panic. But Warren held on. Eventually, the stock recovered to $40. And he sold out, making a small profit. But shortly after he sold, the stock rose to $200. And that experience left a deep impression. The lesson was one of patience. Selling too early cost him far more than the initial decline ever did. And it was an early reminder that markets reward those who can wait. As Warren moved into his teenage years, his fascination with business only intensified. He took on newspaper routes and began earning more money than many adults at the time. He bought used pinball machines, placed them in a barber's shop, and split the profits with the owners. He collected and resold golf balls. He traded stamps. He even created statistical sheets for horse racing gamblers. By the time he'd finished high school, Warren had saved the equivalent of tens of thousands of dollars in today's money. But more importantly, he learned how money worked. He learned about capital, reinvestment, and compounding. And he learned that he loved the process, the game of business itself. After high school, Warren applied to Harvard Business School. He was confident, he interviewed, and he was rejected. A setback for many, but not for Warren. Instead, he asked himself a simple question. Where could he learn from the very best? And that question led him to Columbia University, where he encountered the man who would change his life, Benjamin Graham. Graham, of course, was the father of value investing and the author of The Intelligent Investor, a book Buffett came across very early in his investing career, and one he still describes as the best investing book ever written. Graham believed in buying companies that were undervalued, businesses trading below their intrinsic worth. He called them cigar butts, companies that might be a little bit disgusting, but that still had one good puff left. And Buffett absorbed Graham's teachings completely. He later said, "I was like a duckling who had found his mother." At Columbia, he learned 3 principles that would shape his entire career. That price is what you pay, and value is what you get. That the market is a voting machine in the short term, but a weighing machine in the long term. And that every investment should include a margin of safety. But there was one more lesson waiting for him, and it came from a company called GEICO. In 1951, at the age of 20, Buffett discovered that Benjamin Graham was an investor and board member of GEICO. Determined to learn more, he took a train from New York to Washington, D.C., walked to GEICO's headquarters, and knocked on the door unannounced. A janitor let him in, and Buffett asked if anyone could explain the business to him. He was introduced to Lorimer Davidson, who would later become GEICO's CEO. Davidson spent 4 hours explaining the economics of insurance to this curious young student. Buffett was captivated. GEICO had a unique model. It sold insurance directly to customers, rather than through agents, reducing cost and increasing profitability. And so Buffett invested nearly all of his savings into GEICO. It was his first major investment and proved to be one of the very best of his life. This moment marked a turning point. Buffett realised that he didn't want to buy merely cheap companies. He wanted to buy great companies. Businesses with durable advantages, strong economics, and great prospects for growth. GEICO was to prove the first of many. After graduating, Buffett returned to Omaha and worked briefly at his father's brokerage firm. But he really didn't enjoy selling stocks to people who didn't understand them. He wanted to invest, not to persuade. So he began teaching night classes on investing and saving money to start his own partnership. In 1956, he launched Buffett Associates with 7 investors and $105,000 in capital. Warren contributed just $100 of his own money. But he had something far more valuable, a strategy grounded in discipline and rationality. Over the next 13 years, Buffett's partnerships delivered extraordinary returns. He focused on undervalued companies, avoided speculation, and refused to invest in companies he didn't understand. But one investment really stands out, not because it was brilliant, but because it taught him a lesson he would never forget. In the early 1960s, Buffett noticed a struggling textile company called Berkshire Hathaway. The stock was cheap, very cheap, a classic Graham opportunity. Buffett bought shares, then more, and eventually took control of the company. But the textile business was dying. Buffett later described it as one of his worst investments. And yet this mistake became the foundation of his empire. Instead of trying to revive the textile mills, Buffett used Berkshire Hathaway as a holding company, a vehicle for acquiring better businesses. Insurance companies, newspapers, retailers, manufacturers. Berkshire became a machine for compounding capital. The mistake became a masterstroke. By the late 1960s, Buffett's philosophy had evolved further. Graham had taught him how to find cheap stocks, but Charlie Munger, who would go on to become Buffett's longtime partner, taught him something else. That it is better to buy a great business at a fair price than a fair business at a great price. This shift led Buffett to companies like See's Candies, Coca-Cola, American Express, and the Washington Post. Businesses with strong brands, loyal customers, and durable competitive advantages. Buffett had found his true style. And as we close out this edition, it is worth reflecting on what Buffett's early journey represents. It represents curiosity, a willingness to question, to explore and to learn. It represents discipline, the patience to wait, the humility to adapt, and the courage to think independently. And it represents evolution. The understanding that even the most successful investors refine their approach over time. But above all, Buffett's story reminds us of something fundamental. That intelligent investing is not built on complexity. It is built on clarity. On understanding what you know, on recognising what you don't, and on making decisions grounded in reality rather than emotion. His early experiences, from his first stock purchase to his encounter with Benjamin Graham, illustrate the timeless principles that continue to guide value investors today. Principles that remain as relevant now as they were decades ago. So, if there is one lesson to take from Buffett's beginnings, it is perhaps this. Great investors are not defined by extraordinary predictions. They are defined by consistent habits, by sound judgment, and by a commitment to learning that never truly ends. I do hope you've enjoyed this investigation into Warren Buffett's formative years, and the insights they offer for anyone seeking to invest with intelligence and discipline. Do add to playlist, do subscribe, so you need never risk missing a future edition. Also, do check out the new Substack newsletter, which can be found at substack.com and by searching IIT Podcast. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.